So this is the first lecture for the second semester regarding property development economics. Last semester you were looking at the costs arising from conducting development. Now we want to find out what the value side of the equation, the demand side, and we want to be able to understand how you conduct a valuation of a completed development so that we can work out what land is worth. We need to actually try and understand the methodology and build that up so that you gain some competence and you can then demonstrate that understanding in your written examinations. So today's lecture is really just trying to set the scene so that we can then build up our knowledge and understanding, increase the sort of so-called complexity, bring in additional variables so we can get closer to, in quotes, reality. So we're looking at land valuation. What do we do? What's involved? Why do we do it? So we don't just do it for our health. It's to do with certain purposes, and there's certain methods that you can use and adopt. Each method will have their own assumptions, so the assumptions need to be understood, and as long as you declare those assumptions, then of course the valuation is as good as those that are made and declared. Valuation is all about looking at the hypothetical. We're trying to make decisions, so we're trying to help people make decisions so that they can pay the right price for land. And to do that, they need to work out what something is worth now, so they can then bid and negotiate in the land market so that they are successful when they get off the site in terms of their profit. So in some cases, we're actually trying to work out in the context of what is called appraisal. Appraisal is you do something before something happens. We're looking at value in terms of both the value of the finished and completed development, and we're looking at value in terms of the return you might want to get from spending money in terms of profit, and we're concerned with what you can pay for land, and ultimately that will depend upon negotiation and bargaining and competition within that market. You know from other modules like land use economics that land has many uses, and therefore subject to planning, land can actually move through the planning system to actually achieve different use class, and each use class will tend to have its own market and own dynamics. We need to understand the costs of development in terms of how we measure buildings. The difference between gross and net terms are obviously very important. When we measure a building in terms of its gross size, that's important for the cost side of the calculation. We need to look at the net floor area in terms of the valuation, i.e. the rental flow and so on. And I'm sure that you can remember how to measure a building from some of the work you did in property appraisal in year one with Andrew Ellison. So we need to remember that we're working in a context of the economy, regional, local context. We need to know how those markets are working. So we're dealing with supply and demand. We're dealing with different opportunities, different constraints, which are often generated and created by the planning system. Land must go through the planning system. We can't ignore it. And we need to try and understand profit and cash flow, and ultimately viability, comparing one opportunity against another, because land can be used for different purposes. And of course you can spend your money on different asset classes, so you not only looking at, say, housing, but you might want to look into other forms of property, but also other forms of assets like stocks and shares and other forms of speculation. So we're looking at development economics the value side of that in relationship to property. So we're looking at land and buildings and the uses to which those buildings can be put given market circumstance. So these are the sorts of concepts that you're going to be looking at, using. So you need to be confident in using these words. So you need to actually go and look at the textbooks that are recommended. Look at Radcliffe, Stubbs and Keeping. Look at Harvard and Wyatt and even Myers in terms of generic concepts in economics which are underpinning the methodology you apply to conduct a valuation for land or an appraisal of profit. You're used to doing investment valuations, and that's really about how you get the best return from an asset that's already there. We're concerned with what something's worth before it's created. We need to work out what you should pay for land, and therefore in that respect we're going to make some guesses, hopefully some educated guesses, some structured analysis which will help and underpin some critical issues to do with decision making. Our purpose is to provide information and hopefully well-grounded intelligence so that we can inform the decision-making process. We're not here to give answers or give the answer. Let them take your information and your recommendations, because they will actually then put it alongside other factors which might be related to their company, their shareholdings and other opportunities, and then they can take decisions. So you're providing hopefully well-grounded, well-researched, competent evidence. Okay? And you'll do it according to a code of conduct which is embraced by the RICS Red Book of Manual and Appraisal. The version now is 2011. That's available through library sources in terms of the databases, and I do suggest you try and at least look at it once if you haven't used it. Land can be used for different purposes and for different options, and obviously that depends upon whether we want to clear the land, if it's got buildings upon it, and we can change the uses or change the form. We can intensify the use by actually changing uses, building more buildings, building higher, changing the mass. All these are things which we could model and value to work out what is best. All those decision making and options and choices should be set in the context of risk taking. Okay, so every decision there'll always be a bit of a question mark, and what we've got to try and do is to make sure that we've included all the costs that you think are going to be triggered by the development, and that you've really got some very good evidence about the valuation side, i.e. the demand side of the market. The demand side of the market is the most difficult part of the research exercise, okay? Because you and I are fickle. We can change our minds. And it's our derived demand for space, our willingness to pay, the amount of money we spend, the frequency in which we actually go to shopping and so on, will determine how successful property is as an asset class. And ultimately, it will affect the value of the buildings and the number of buildings that we might want to put up.